Hello everyone and welcome to this week's FX webinar. My name's Craig Erlam, Senior Market Analyst at OANDA. I hope you've all had a fantastic weekend. Looking forward to an interesting week ahead, I think it's safe to say. It's interesting right now that politics really has taken over. Obviously, the central banks have been a very prominent feature, will continue to be a very prominent feature going forward. But in this period of the summer, it does tend to be a lot quieter on that front. Of course, policymakers are entitled to holidays as well as are lawmakers, which is why you are typically seeing a quieter period now. And the economic data, once the first week or so gets out the way, it also tends to dry up a fair bit as well. Politics usually goes a bit quiet also, but it hasn't been the case very much on this occasion. Whether we are talking about the situation in Italy, where Matteo Salvini, the leader of the League Party, part of the coalition government with the Five Star Movement, has recalled the Senate in order to set date to vote on a to follow a no confidence vote in the government, trying to capitalize on the surge in the poll ratings post the EU election, or whether it's the situation right now in Argentina, which has really heated up overnight, where the primary round of voting, which in many ways is symbolic because with there being only two candidates, saw the current president Macri heavily defeated ahead of this October election, which could be incredibly disruptive. We have a situation right now whereby, from a market's perspective, he is quite clearly the favored candidate. He is. They are currently undergoing an IMF program, and the focus really is on regaining economic stability over the medium to long term. And again, that's been favorable with the markets. Of course, though, when you're heading into election, if you have a recession on your hands and you have very high inflation and people are struggling to get by, we shouldn't be surprised that they turn to a more populist alternative. And that seems to be where it is now headed, unless Macri can really turn things around over the next couple of months. But the markets responded incredibly. The Argentinian stock market sold off, if I'm not mistaken, around 50%. The peso sold off, I think it was as high as 30% at one point, reversed about much of that to drop 15% overnight. I mean, that is a staggering decline in a currency overnight. So, I mean, just to put into perspective, the pound fell 10% after Brexit. So for that to happen just from a leadership race, it is really, really damning of how the markets perceive the direction of travel for Argentina right now, unless, like say, Macri can really turn things around. But it's not just these two. Of course, Hong Kong continues to be in the headlines. The situation we're seeing there is clearly deteriorating. It's lasted a number of weeks now. It's taken its toll on the economy. It's taking its toll on business. It's taking its toll, of course, with the latest situation on the airports, on people's ability to travel, people's desire, of course, as well. And it's showing no signs of easing up. It's incredible to think that all of these things are providing a huge distraction right now from what previously was the major political stories, being, of course, the US-China trade war, which has gone very quiet, although not improved, which is why we're seeing stock markets continuing to struggle. And then, of course, if you are in the UK, Brexit, which hasn't gone away. We have seen a ramping up of the no-deal talk since Boris Johnson became Prime Minister a few weeks ago. But again, with it being summer, we're not actually seeing any real progress, but we're also not seeing any signs that either side is willing to back down. That's a lot of politics to get into one mouthful. So I hope you've enjoyed that first 5-minute summary of the global political order right now. We will move on with, obviously, we will touch on some of these issues again. But of course, all of that's happening right now is really weighing on investor sentiment is the important thing in a period of when you typically do see lighter liquidity in the markets. Again, people taking holidays does tend to affect this time of the year, but the political order or disorder, as you may see it, is certainly giving us plenty of food for thought, plenty to sink our teeth into, and it's ensuring that markets are anything but boring. So Here you will see the economic calendar. I should note that what you should have seen on the first page is the OANDA MarketPulse website. For those of you who have not attended one of these before, this is where myself and my colleagues around the world post the content each and every day, covering a variety of markets, instruments, and topics. Of course, we're heading into the US session, so my colleagues over there will start to post very shortly. And yeah, we try to cover as much as we possibly can, really. As ever, if anyone has anything that they see a gap and they would like to us cover more of it, please do just reach out, let us know. We're always looking for gaps to fill. But yeah, this is basically where you'll find all of our content every day. And it's also where you'll find the economic calendar, which we just touched on here. It's also where you'll find a recording of this webinar later on today. So if you do miss any bits or you want to go back, then feel free to do so. You'll be able to find it right here. You'll also be able to find it on YouTube. And if you're following me on Twitter, Craig_Forex, you should be able to find it there as well. As ever with these sessions, they are intended to be they are meant to be interactive, so please do ask any questions that you have. If not, then that's absolutely fine too. I will just crack on as I go. It's really interesting that this week it is relatively quiet, but at the same time there are a number of data points which could typically attract a lot of attention. Whether they will or not, as we've seen this morning, is another matter entirely. The start of the week was very, very quiet. Earnings season is more than 90% done at this point, so really that is drawing to a close and focus is shifting very much away from that. That's in the US, of course, but around the world we have got a lot of data. This week is typically a big date for UK data, but as we saw this morning, the numbers weren't really in line, but we didn't see hardly any movement in the pound. We saw it rally 10-20 pip, but not very much at all. And really that's because it was quite the mixed bag. On the one hand, we saw unemployment tick higher from 3.8 to 3.9%. That's still close to a 44-year low, so hardly the end of the world. We also saw job creation exceeded expectations, but that acceleration was really largely part-time employment, which does raise concerns of its own, because heading into the October 31st deadline, it shows that employers do not really share the confidence. They're effectively hiring people that will be easy to let go in the event of a worst case scenario, potentially. Obviously, there's no guarantee that that will happen, but that is the message that kind of behavior does typically send. Now, the flip side of that is that earnings numbers were really strong. And what this effectively tells us is that in the event that we actually see a Brexit deal, which means we don't get the economic fallout as a result, then the Bank of England really has something serious to consider on its hands. Because while we are seeing a global downturn, we have seen a slowdown in the UK economy now for quite some time. Inflation is at target and earnings are at 3.7% if you include bonuses, 3.9% if you don't include bonuses. When you strip out inflation, that's 1.8% and 1.9%. Again, very strong wage growth here. And perhaps given that it's very much behind the curve because of the way Brexit has panned out so far, the Bank of England may be looking at this thinking that this could warrant some form of tightening of monetary policy, very much going against the curve of other central banks right now who are instead cutting interest rates. The ZEW economic sentiment readings from Germany and the Eurozone are clearly quite appalling. And we'll look at the impact that that's had on the euro very shortly. But like I say, this is a situation which is clearly not getting any better and is clearly acting as a major drag on confidence. You look at what we've seen here just since April alone. This has absolutely tanked. This is the worst levels that we're seeing now since 2011, 2012. So this is the very peak of the Eurozone debt crisis, when people were fearing the collapse, effectively, potential collapse of the euro area. Now, I always say it's not worth reading far too much into these one-off readings. That is such a massive plunge. I am curious as to whether that will be sustained or whether we'll see a sharp rebound. But naturally, it does just grab people's attention because the state of the Eurozone economy at this moment in time. And then today we also have the US inflation data. Now, again, there's two things which we have to consider here. One is that this is the most timely reading of inflation we get. It comes 2 weeks prior to the next reading. The issue that is that the next reading is the Fed's preferred measure, which is the core PCE price index. it's not necessarily favored. The CPI is not necessarily the favored number, but given the timeliness of it, it does tend to still attract plenty of attention, and that's expected to show a slight uptick in overall inflation and steady core inflation. Now, this has inflation at 2%, roughly there or thereabouts. That's on target. It's very much the PCE number which has slipped below that and well below that, and has generally been a little softer than the CPI numbers. So what we're really looking for here isn't necessarily the value itself, because I don't think the Fed is going to change policy based upon this. It's really the direction of travel. If we start to see a softening in price pressures here, then you would expect to see the same in 2 weeks. And again, that just ramps up the pressure on the Federal Reserve. Wednesday, we've got the usual flurry of Chinese data. So that's retail sales, industrial production, and I think fixed asset investment, which for some reason has dropped down to a single tier piece of data here. So that's I'm not entirely sure why that has, but that will also be released alongside these two figures. And then later in the morning, we get GDP data from Germany, and that's expected currently to show a contraction of 0.1% in the second quarter. That means that it, like the UK, would be at risk of a recession. This, in my view, really does play into the hands of the Brexiteers, really, because while I don't think anyone in the UK expects a recession in the third quarter of this year, the issue that we have is the data is actually released on the third quarter in early November, which means that prior to this deadline, the risk of recession may well be used as a tool by Remainers or People's Vote campaigners as a stick to beat those seeking a no deal with. The flip side of that is, if Germany contracts as well, then that gives them an alternate. That gives them one of their own to say, well, this may they may choose to say that this has nothing to do with Brexit, that this is part of a global slowdown, that we're seeing it in Germany, we're seeing it in Italy, we're seeing it elsewhere. But broadly speaking, this contraction here isn't entirely surprising given the data that we've seen now for a number of months. We get UK inflation data on Wednesday. This isn't that important for me because of the Brexit situation being so important right now and the fact that it's so steady around that 2% level. Eurozone GDP, of course, very, very slow growth. Again, no surprises there. We're not expecting too much of a change on that front. Thursday is UK retail sales and US retail sales as well. Again, it's just quite an interesting one, because if we do see, it's one of these situations whereby, take the US as an example, if we do see a slowdown in the data, and I think markets will jump on it because it's almost thriving on weakness right now, because it forces the hand of the Fed to further cut interest rates this year. Markets are already pricing in more than a 70% chance of a 25 basis point rate cut in September, with a 30% chance of or around a 30% chance of a 50 basis point cut. So markets are completely convinced by September. And as I say, because it's the summer period, the Fed hasn't been out managing these expectations. It will be interesting to see if they choose to, when we do see them start to return to the scene. And so that's going to be one to watch. If this is weaker, though, I wouldn't be surprised if markets do jump on it. Again, stronger, perhaps it will create that little bit of dollar strength potentially, but I don't think markets are going to be convinced by one or even two pieces of data. I think the message will have to come from the Fed that interest rates are not necessarily being cut. But we also get to do a whole host. We also do get a whole host of other US data as well, which I think is really interesting. So things like unit labor costs, again, good inflation gauges. Non-farm productivity, again, feeds into that inflation gauge. The Philly Fed manufacturing index, industrial production, jobless claims. This is a lot of data to be getting. The only thing is, I'm just not sure how interested people are going to be unless the news is bad, which is one of those really bizarre situations that we currently find ourselves in. The Australian employment data, I think, is another interesting one. Of course, the Australian Central Bank refrained from cutting interest rates from a third meeting in a row, but they did at the two previous meetings prior to that, and they do seem to be favouring another rate cut at least once this year. The labour market is one that's remained okay, but not necessarily a particular source of strength. So again, this employment data may actually be of interest to the RBA ahead of that release. So if we see any weakness here, then I would imagine that may increase the chances of a rate cut at the next meeting. And then finally, Friday, building permits, housing starts. Again, the original source of weakness in many people's eyes for the US economy. This is we've seen a slowing here now, really, since the start of last year. That we've seen we've seen a little bit of a bounce recently. Now that rates have started to come off just a little bit. Again, if we see a kind of recovery here, then that is the type of thing that could convince the Fed that economic activity is being shored up by the actions they've already taken. But I think we'd need to see more data and more evidence to support this. So like I say, a lot of data, I'd say a lot of medium tier data, and even the higher tier data was the stuff that might not get markets too excited, as we saw this morning in the UK, but still plenty to get our teeth into, plenty to read into in this otherwise quite economic period. But again, really, politics is king right now, and I think that's the key message to take away from the current environment we find ourselves in. Now, on that note, you should all see the charts on the screen, and we'll crack straight on with euro dollar. We'll move along in the normal order. If you've got anything that you would like me to touch on, if you've got any comments on the charts which I'm covering, and please do send me a message. I'll happily go into this again. In the one of the benefits of these sessions is the ability to be a little bit more interactive. So euro dollar has very much steadied off. Now, this obviously isn't coming from sudden euro strength, sudden positivity by any stretch of the imagination here. This is, broadly speaking, a dollar-driven move. We have seen a little bit of softness in the dollar as of late, but again, we're already running into a lot of resistance here around that kind of 112, 112.50 area. What's interesting, though, is that we haven't seen another run to the downside. Instead, we're actually, the last couple of days, seeing a little bit of positive momentum building again. So that makes me think that we're not necessarily heading back towards these kind of 110 levels that were looking quite dangerous here earlier in the month. Instead, this is probably a little bit of a bullish signal currently, not one I'm convinced by, because just look at that Eurozone data this morning. That's a prime example. But perhaps one of the things which is aiding this move in particular is the bets that we're seeing on the Fed to cut interest rates more aggressively than it's currently alluding to. As you can see, this kind of 112.50 area, 112 to 112.50 has been interesting now for quite some time. You see around this period here it was, around this period here, and here. So basically, since we started to stabilize during the sell-off back in the kind of towards the end of the first quarter this year, that kind of 112, 112.50 has always been an area of interest. If we do break through there, I'm not exactly expecting a surge higher, but it does draw a lot of intrigue to 113. Again, let's look back. 113 for a long time has been an area of support on the way down and potential resistance on the way up. The fact that it now coincides with that 233 day simple moving average band makes it all the more interesting again. Naturally, what I'd like to see longer term is a breakthrough this kind of 114, take out those previous peaks and move higher, but this would be a very good start. I just wonder what it will actually take to get us there, because we can't rely on euro strength, and I'm not sure the dollar is yet ready for this kind of weakness, but we will see. We will see. The pound has also benefited in the last couple of days from this kind of dollar weakness. Maybe it's also benefited from the lack of no deal rhetoric, but really not too much. We're back. We've hit these kind of 120 levels. We fell just shy of that before we saw a bit of profit taking. What's interesting is that we may be about to start to see a little bit of divergence here, potentially in the stochastic ever so slightly, but the MACD histogram very much so. A little bit of a flattening in the moving averages. It has been quite an aggressive sell-off since Theresa May, since it became quite clear that Theresa May was at the end of the road, that her message wasn't being heard, that she was running out of options. So it has been quite the sell-off. So it's not a surprise that we are potentially running out of a little bit of steam right now, but in this kind of environment where headlines are such important drivers, it really wouldn't surprise me if we do see another big PR push from the Boris team. It's the important thing here is Boris does not want to be seen to be making the same mistakes that Theresa May made. If you remember, Theresa May's message in the early days was no deal is better than a bad deal. The only problem with that is she never truly believed it. She never really thought that no deal was a good alternative. She never even engaged in too much no deal planning. She didn't want to be seen to be wasting money. She released economic forecasts, or she was responsible for the release of economic forecasts, which showed the devastating impacts that no deal could have. And that message was quite clear to everyone, including the EU. So the EU never really had an incentive to take that threat seriously, or to remove or to discuss the backstop in the withdrawal agreement, because in their eyes, we were never going to leave with a no deal. Parliament was against the no deal, so they could continue to stand by the that part of the withdrawal agreement, and they may still do. But Boris wants to make sure that they are aware that no deal is on the table, and that while Parliament may oppose this, he has means and methods of getting around that. We don't necessarily know what they are at this moment in time, or if this is one big bluff. What we do know is that he's putting money aside for no deal planning. He's doing a lot of talk about the prospect of no deal, about how he doesn't want it, but he will do it, that we are leaving on the 31st of October no matter what. And the markets believe him. And that is key. The fact that the markets believe him may well eventually lead to the EU believing him. And that is where we will see this start to actually now move forward. We'll either move forward in that the EU will accept no deal is the reality and start planning for what they're going to do on the Northern Irish border, because we've got to remember the backstop is there to prevent a border going up, to stop infrastructure appearing on the border between the Republic Island and Northern Ireland. But in the event of no deal, that is effectively what will have to happen anyway. And the question then becomes, who does it? I guess from the UK's perspective, and I don't know all the legal details of all this, but if the UK decided that they're happy for things to cross the border from the Republic Island into Northern Ireland, especially in the near term, while they find a solution to avoid the disruption, then potentially, if the EU wants to avoid things entering into that economic bloc, then it would have to be them that would be responsible for the infrastructure. And then it'd be a question of where it goes and how they get around it. So by putting the ball in the EU's court, Boris and his team may believe that he can re-engage them on the issue of the backstop. Again, I'm not entirely sure on all the legal details in association with that, but I imagine we'll hear a lot more about this over the next 2.5 months. But as I say, the important thing here is that the markets believe Boris and his message, which is why we're back at these 120 levels. 120, which at one point was the levels that people were saying we'd hit in the event of no deal. So all of a sudden, those forecasts have changed dramatically. A lot of people saying they could still see another 5-10% drop if we do go over that threshold on the 31st of October. A lot can happen in that time. This is certainly going to be very interesting. If we do see a move to the upside, then I think this 124, 123.50, 124 is really key. This has been historically an area of kind of support and resistance, most recently as well. And it would also take us up through this top of the rising channel. Of course, I think we could potentially, at least in the early days, start to find resistance right, left, and centre, if I'm honest. This kind of 125 area could be really interesting, but you could say that about a lot of different areas. Almost every 100 pips, you could say, is a really interesting level on that way up. Maybe once you're through 128, then it could start to say that's the light at the end of the tunnel. You're taking out some major support zones here, major resistance zones on the way down. You'd be taking on the 200 to 233-day simple moving average band. We are so far away from that, but at that point, you may start to feel a little bit more confident. But in the early stages, if we do see a turnaround, I do feel like you're going to see a lot of resistance along the way. Unless, of course, that turnaround is driven by a positive breakthrough. Euro sterling is not looking much healthier. We entered into this long-term range, which I always said was really interesting, because for a long time, this has been an area where every time we've entered into it, the market's found a reason to eventually rotate lower within that area, that kind of 91, 93 bracket. We're talking very, very long term. The initial, obviously, one for that we had that in mind for as well was the kind of 90, 50 through 91. But we just stormed through there eventually on this no deal rhetoric. And it took a massively aggressive push to actually get us through there, but at the first time of asking, which was interesting. We then look at the 93 kind of area, and even along the way, maybe 91.50. But 93 is now where we're held up. That's this previous area resistance back here in August of 2017. The interesting thing in this actual case is that we're not necessarily seeing lagging momentum too much. potentially flattening off of the MACD histogram, potential flattening off of the stochastic, no flattening off of the MACD moving averages. I would not be particularly confident that we are going to see this necessarily rotate lower just yet. In terms of where it is interesting above here, then the kind of 94 levels become more interesting, and then we're looking really long term in terms of when these levels were last hit. So 94, basically, we're looking back at these levels here back in October 2009. So now we're suddenly looking back just post financial crisis type of levels when we're talking weakness in the pound. So yeah, obviously a very long time. So 93, 94, and also the big round numbers do tend to come into play here when we're starting to hit these. It's not uncharted territory, but it's very much territory that we haven't spent an awful lot of time in. But it's just interesting because we've seen such a strong rally and momentum just isn't really softening just yet. The Aussie dollar is obviously looking a lot weaker, much to the Reserve Bank of Australia's pleasure. The cuts that we've seen, the 2 interest rate cuts in a row, of course, have played a huge part in this. For anyone who's followed these webinars previously, I've long said I'd love to see a move higher. We're not being handed that just yet, and we may have to wait a little bit while longer. We may have to wait for the RBA, for example, to adopt a much more neutral stance. I think I did see a comment earlier today from an RBA policymaker, I can't forget who it was, who suggested that they're quite happy with the way the currency and the market and the economy has responded to the rate cuts that they've imposed already. Perhaps that's a slight softening of the dovish stance. I still think we'll probably see another rate cut pretty soon. And then we see if we start to see them adopt a more neutral stance at that point. Of course, the Chinese slowdown is having negative consequences for them. China is a massive importer of raw materials from Australia, so that's going to have negative knock-on effects. But there is also other issues within the economy as well, which is why we are seeing this. The housing market is the one that's often touted, even though I think we've seen a little bit of improvement there. But we're back at these kind of 67 levels, and we do seem to have seen a little bit of a rebound here, of course, earlier on this month. But what's interesting is we've immediately run into resistance around these kind of 68 to 68.50 levels. Now, I've drawn the trend line all the way back here, but this was the ultimate low here for quite a long time back in January 2016, which is what makes this level so interesting. But really, this entire area was a major area of support for a while, and it looked as though we were just gathering a little bit of an upward momentum here into the 71s. I really had my fingers crossed that we were going to see a breakthrough there. It never materialized, so be it. And now we're back in the doldrums again. 67 is support here. If we break through there, then that's again just the big round number 66 would be interesting, and so on. Given that it's been such a long time since we've been at these levels. Again, scrolling back, we're having to go back quite a far way. Last time we were trading at these levels. So we say 67. So we're currently trading around these kind of 67.50s. But really, if we're looking back at these longer term levels, then perhaps you could have an argument for this kind of 66, which again is the next round number. Again, just looking at these peaks. Really, what I'd want it's these kind of 63s where it starts to become a lot more interesting again. You can see in this period of October 2008, and then throughout this period, really from December through till March of 2009, the kind of 63s were key, and then below here, obviously around the 60, which would effectively go without saying, really, that once you're hitting the big round numbers, that it starts to become a lot more noteworthy. Again, purely psychological, but this does play a role that we often see in these markets. But I'll be very interested to see how these momentum indicators do now. That's such a sharp pullback, and we're not necessarily gathering huge momentum to the downside just yet. Dollar CAD is a very different story because the Canadian Central Bank isn't really one that's adopted the dovish tone. So we're not really expecting a rate cut from the Bank of Canada anytime soon. We have had a pullback here in the dollar, which has driven this, and obviously the softness in oil has also contributed very much to this. the softness in oil, which is driven by low downward revisions to global growth expectations, which leads to downward revisions of oil demand growth forecasts as well, and that's weighing to an extent on the Canadian currency. We've got into this 50-61.8 fib zone, and we've rotated low. This isn't just a fib zone, this is also the moving average cross here, and it's also where we've got that prior area support. So this was always going to be a really interesting level. The fact that we've rotated lower off here is encouraging. If we want to see a continued rotation lower here, then I think it's going to be important that we don't see a break of this previous peak here where they get kind of 133.50 areas. If we see a break through this kind of zone 133.50, 134, then things may actually start to look a lot more bullish here. And this would look less like a correction and more like an actual trend reversal. So potentially something to keep a close eye on. Sterling is no match for the Canadian dollar right now, even if its central bank isn't necessarily, in the event of a Brexit deal, going to be favouring rate cuts. But the fact that markets are pricing in more chance of a no deal, which means they're pricing in more chance of interest rate cuts. Now, this again has been a bit of a one-way, moving in a bit of a one direction. But what's interesting is this kind of 158 level. Again, you can see two occasions really. We're going back to the start of 2017 where this kind of 158 has been very notable. If we scroll even further back, we've got a very long-term trend line. Again, I'm not reading too much into this. It's only a couple of points, but it's two of the ultimate lows that we've seen for a very long time. The fact that it approaches at this kind of 158 level may make it noteworthy. It may make it irrelevant. It may make it coincidental because it approaches around the same time of these previous lows. But again, what's interesting is the momentum here. Higher lows, flattening if not higher lows, price is lower lows. Momentum is clearly starting to wane the lower we get here. The fact that we're approaching what is potentially a noteworthy area of support in this may be coincidence, it may not be. But even if we make a new low, if we do that on lower momentum again, then you may start to see a little bit more profit taking, potentially kicking in. If we break 158, then maybe that starts to pick up again. But this has been a very, very aggressive trend, and it looks to be one that's potentially running out of a little bit of steam. If we do see a rotation higher, then this area around 162 becomes interesting. That's kind of the first test as far as this pair is concerned, because it was support here, resistance on the recent corrective move. And then above there, kind of the maybe, let's remove this. Might actually remove a number of these at this point. We've sold off so aggressively, we've just broken through support after support after support. Right now, I'm kind of looking at these areas here around the 162. If we break through here, then it's kind of this 160, 164. You can see again a couple of occasions here in this area here, but then more recently here. And then really around these kind of 166s. So basically 200 pip clips really is where it is the areas I'll be keeping a close eye on if we do see that kind of rotation higher from these lows. So potential areas to keep an eye on, areas where the markets have responded previously effectively is what I'm saying. Kiwi dollar, much like the RBA, the Kiwi Central Bank, the Reserve Bank of New Zealand has been cutting interest rates. They didn't do it in 2 consecutive meetings, but they have still done it twice. The last rate cut that we saw from them a week ago, they surprised markets by cutting rates by 50 basis points rather than 25, which is what contributed to this move here. Very big sell-off in the Kiwi dollar because they exceeded market expectations. That took us back towards these kind of 64s. We've rebounded obviously off the knee-jerk reaction from this. But again, these momentum indicators suggest that perhaps the markets are looking at this as not necessarily a one and done from the central bank, but a sign that they wanted to get this sharp cut in early, deliver a big blow in that sense, and hope that they maybe don't need to act now for a few months. So potentially a sign that they have maybe become a little bit more neutral as a result of that. There's no guarantee that that's the case. We'll see what they've got to say in the coming weeks. But markets, the fact that this has slowed down somewhat since that interest rate cut, suggests to me that markets are looking a little bit more cautious. on this. In terms of to the upside, again, the interesting level here for me is 165. Again, you can see a little test of it here, but it's also this support area back here. And then above it is this resistance zone here, potential resistance at around kind of 165.75, 166. Previously been noteworthy area of support and resistance. So one to keep an eye on. As ever, we'll wrap things up with the yen pairs. Dollar yen has been tearing lower, so maybe a sign of things to come. The yen is widely viewed as a safe haven currency. Just look at the movement in gold to see what investors have been flocking towards now for the last couple of months. Well, the same is very much true here. This has taken the yen back towards these kind of 105 levels. 105, which is where we hit during the flash spike in the yen back in January, but also the kind of levels that we hit back in March of 2018. I feel like we've also hit these levels before, back in November 2016 was noteworthy. I feel like I've talked about this a lot over the years, it's kind of 105. But this isn't looking particularly good for this pair, to be honest. Even at these levels, we're not lagging any momentum. If anything, it seems to be picking up a little bit. This does look like a market which is potentially prone for a bit of a correction. I always favor the big numbers in terms of noteworthy levels. So 106, 107, 108. 108 is the biggie for me, but 106, 107 along the way could be noteworthy if we do see a rotation backwards. I'm just not sure I see sentiment picking up to justify, and potentially the markets are sending a signal that they don't either. What happens when you pit a very risk-sensitive currency against a risk-averse currency? Well, you see a chart like sterling yen. Pound's been performing poorly, the yen has been performing wonderfully. So we've gone from 145, 146 through to 126. That's quite a decline. And we look at this now, potentially starting to see a little bit of momentum shift out of it. Again, that may be driven by the fact that lots now being priced in for the pound. It still looks extremely vulnerable. It seems that there's potential that this is maybe a little bit overcrowded, the kind of sterling short trade, but the problem is it's being driven by politics, and politics is very fluid, but it's also very negative right now, particularly on the Brexit front. I really wouldn't be surprised to see this I wouldn't be surprised if this does continue to decline. How much further is the difficulty? But this kind of 126, 125 through 126, previously, talking back in 2016, was a really important level of support here. It's actually where we bottomed out and we then started to move on up from. So we may start to see traders get a little bit nervous around these levels because they have done previously. We may see some profit taken, and if we do see that, then I'd expect to see the momentum indicators reflect that. But then it only takes a lot more no-deal rhetoric, as we've seen plenty of, and that kind of spreads panic in the currency, and we all know what happens next. So I wouldn't say I'm feeling particularly bullish about this pair right now. I feel like it's still very vulnerable. But the momentum indicators is potentially suggesting that a lot is now priced in. Euro yen just taking out more lows. We stabilized around this kind of 118.50, 118 low previously back at the start of the month. We rotated high. We fell just shy of actually testing the previous low before we rotated low. We've made a new low. This most recent low, though, so far, it hasn't necessarily completed yet, but so far the momentum is not necessarily backing it up. So that suggests to me that there is potentially running out of a little bit of steam here. Again, the euro is performing a little bit worse, a little bit better than the pound, which is potentially supporting this. Looking back historically, if we do break through these levels, then I think the ones that really stand out to me is this kind of 116 through 116.50 area. Again, you can see during this period in particular, this was quite noteworthy. But for me, I think I'd want to see some momentum start to back up this move because it is starting to lag. Again, we saw this kind of sharp little volatile piece of trading here, and maybe that's just knocked the stuffing out this decline just a little bit. Again, the fact that the euro is performing relatively okay, particularly against the dollar recently, and the pound is helping to provide some support here. But we are still, it feels, in risk-averse markets, so it's not. It feels like the wrong time to be maybe calling the end of the yen rally. But again, very volatile markets. I guess this is what excites us about them. This is what we love about them, is their volatility. So who knows? For me, there's been a very strong move lower. so far. And while I'm not necessarily feeling bullish about it, I'm not necessarily feeling a strong move lower just yet. I really want to see if we do start to tread new lows, if momentum does back it up before I start to feel like that can start to actually make another big step lower. But on that note, I hope you all enjoyed this session. I hope you all do check out the website, especially later on to find the recording of this webinar. That's marketpulse.com, where myself and my colleagues do post analysis on a daily basis. But apart from that, I thank you all very much for joining. Also, do check out the podcast, which we do. That's the OANDA Market Insights. That's released every Friday. I think you should be able to see the latest release just here. We do it in podcast and also video form, so please do check that out. But apart from that, I just wish you all the very best of luck with your trading. I hope you'll join us all again next week. I think my colleague Ed in New York will be doing that. So that'll be 12:30 New York time, which is 5:30 p.m. in the UK if you want to join after work. But apart from that, I wish you all the very best of luck with your trading, and I'll hopefully catch you all again very soon. Thank you very much.